there's a lot of anticipation ahead of the speech. I think, Fed Chair Powell will want to keep the options open when it comes to the September meeting. So there's a lot of talk about that September rate cut. I don't think we're going to get a strong signal as to what the decision in September will be. But Fed Chair Powell will be highlighting some latest developments on the outlook. So he might acknowledge what we've seen in the labor market in terms of softening in labor market conditions. And importantly, he's going to be covering the conclusion of the revision of the Fed's framework. So we're going to hear about that. I think it's interesting that it's happening against a very different backdrop than the last one in 2020. We have an economy that has gone through the pandemic. We've seen a new paradigm when it comes to inflation, with now people concerned about persistently high inflation. So I think the Fed will want to take that into account in their review.
And of course, a large part of this conversation does have to do with tariffs. And it's worth mentioning that we did get some tariff news earlier today. The White House and the European Union putting forth this joint statement, perhaps a step in the right direction towards getting pen to paper when it comes to finalizing that agreement for 15% tariffs on EU exports in place, though not yet in place for those sector-specific tariffs, including autos. Lydia, are we actually getting the sort of clarity that we need around tariffs to have this more precise economic forecast, the sort of precision that policymakers need to have in order to make these types of decisions?
No, I think we have a backdrop in terms of tariffs that remain highly uncertain. So I do believe that, with these higher tariffs and the lingering uncertainty that we are seeing on the policy front, we continue to see a downward pressure on economic activity from all that uncertainty. If you look at tariffs today, the average tariff rate is about 18%. We were at 2% last year, so that's a significant step up. And we are starting to see the impact of these tariffs on the economy. So if you think about the outlook in the second half of the year, I do think that this slower economic momentum that we are seeing in the data, in the labor market, but also if you look at the underlying trend in GDP growth, when you look at real final sales to domestic purchasers, we have a clear indication that the economy is slowing down. And in the second half of the year, I think that's a trend that will be sustained. So we do expect to see below trend growth in the second half and heading into 2026.
Lydia, you talked about a slowdown there, but we're also seeing some flashes of impact on prices, perhaps from the tariffs. What is your read on that, on the inflationary impact of these import levies, and how much more will we see going through the end of the year?
Yeah, I think the inflation picture is quite complicated at the moment. There are a lot of cross currents. If you look at the latest CPI reports, I think that was a clear indication of all these cross currents. We have services prices, which had been a key source of this inflation pressure. They showed some renewed momentum in July. At the same time, on the goods side, we had clear indication of pass-through in June and then more moderate pass-through in July. So there is a lot of noise, and it's really a reflection of this sort of messy and uneven process when it comes to the tariff pass-through. But companies are starting to see some pressure on their margins. Higher tariffs are leading to higher costs, and they are leading companies also to start pulling back on hiring as well. So the impact of tariffs is really starting to show up, and I think it will continue to build in the second half of the year.
Can we talk just a little bit more, drill down a little bit more here, including how it pertains to the consumer? I'll add another headline that we got here today, which is Walmart missed profit expectations for the first time in 3 years. Lydia, will slower income growth limit the extent to which firms can pass on these costs of tariffs? What are you watching here when it comes to that dynamic?
Yeah, we are definitely expecting real income growth to slow in the coming months. And that's really driven by both that softening in the labor market, which is the key pillar of consumer spending growth. So that's going to lead to slower labor income growth. And at the same time, you have that renewed reacceleration in inflation. We've seen core inflation, above 3% for the CPI. So that those higher prices, they're also going to be eating into consumers' purchasing power. So if you think about real income growth, you're definitely going to see a slowing trend that's already visible when you look at the data. Consumers have been actually spending above their mean if you look at the annual trend in consumer spending and real disposable income growth. So as you move ahead, you're starting to see some erosion in those fundamentals that are driving the consumer. So yes, for now, consumers are still resilient. I think the retail sales data were encouraging, but there are clear signs that with a softer labor market, with that inflation pressure and also confidence remaining depressed, we're going to see that slower momentum in consumer spending being sustained in the coming months.
Lydia, you talked about a slower labor market. How much more will this influence Fed policymakers? We did hear earlier today from the Kansas City Fed president saying that he was actually more worried about prices than the labor market risk at this moment. But what is your take? Which in the balance weighs more at this point?
Yeah, so yesterday you saw the minutes from the Fed. They did show that you have a majority of policymakers at the Fed that are still seeing the inflation risk, the upside risk to inflation, as being more significant than the labor market risk. Now, that was at the July policy meeting. And since then, what we've seen is that very soft July jobs report. We've seen those massive downward revision to the May and June data. And I do think that when policymakers are looking at labor market conditions today, they are a little bit more concerned about that slowdown that we're seeing. And it's not just the jobs report. If you look at a broad range of labor market indicators, they've been signaling already for a while that labor demand has slowed significantly. The hiring rate is very low. And we are also seeing slower dynamics on the supply side of the labor market as well. So as we get to the September meeting, I do think that the shift will be, the focus will be a little bit more on the labor market side of the Fed's dual mandate. And that's the reason why we do expect to see a rate cut at the September meeting.